legal cannabis industry has unlocked generational wealth opportunities across the country. But the industry's regulatory complexities, constant state of change, and speed of evolution drive confusion for entrepreneurs and investors alike. On this podcast, we'll interview the industry leaders who are shaping the future of the legal cannabis industry to help our listeners understand these idiosyncrasies. This is Cannabis Unlocked, hosted by Key Investment Partners. All right, everybody. Well, welcome to another episode of Unlocking Cannabis with Key Investment Partners. I'm excited to have Tim Seymour here, a good friend of mine, known for a while now. Tim is someone you probably recognize from CNBC's Fast Money. He's also the CIO of Seymour Asset Management, providing wealth management services for his clients, and he's also the portfolio manager of the Seymour Cannabis ETF, ticker CNBS. Tim, feel free to take it away here.
Yeah, it's great to be here. Thanks for having me on, and an interesting conversation ahead. Looking forward to it.
Likewise. So I think to kick things off here, Tim, there's been some recent news that came out last night about the Safe Banking Act being stripped from the defense bill. I think a lot of folks in the industry thought that the Safe Banking Act actually had a pretty decent chance of getting passed either this year or maybe at some point next. I'm curious what your thoughts are on that.
Yeah, I this is going to be unpopular, maybe a sigh of relief, because I just think that the expectations here were interesting, were fair. Putting safe banking and into the National Defense Authorization Act was an interesting strategy, and one that on some level made some sense. But when you consider some of some of the things that I think we still need to get through, even though this is a bill that's going to move quickly, and there was some sense that you even had some bipartisan support. The last 6 weeks have been extraordinary from the legislative macro and then headline perspective for the market, for at least public assets and the impact upon them. And as much as those of us that are focused on the public markets every day are excited to see and recognize that the legislative path and the macro headlines are really the catalysts that we're tied to right now. I think the market's gotten overly focused and consumed with this, and because the bottom line is, I run a cannabis ETF. It's an active strategy. I have a background in emerging markets where investing in Brazil and Russia and China in the late 90s, early 2000s was about a macro headline too, and it was, but that ultimately there really is this bottom-up story and this growth story, and we'll get into that, but an addressable market dynamic and a profitability dynamic that really I think investors need to be focused on and not be investing for any particular federal path. So back to, look, the news last night, a little frustrating, although I think the markets have priced that in and then some. And in fact, again, the sigh of relief comes from the fact that I think the whipsaw action in markets is such that it's actually been very painful, and on some level it's been somewhat destructive for investors that have been trying to trade too aggressively. And we can get also into kind of my view on how investors should approach both trading and investing in cannabis. But look, the Nancy Mace headlines of November 5th, Friday at 3 p.m. Headlines come out that Republican Congresswoman Nancy Mace from South Carolina is bringing forth a Republican effort to really counter maybe the way too broad, possibly overreaching. And again, these are not necessarily my views, although, I'll put it this way. Look, the Chuck Schumer bill, I think we all felt was dead on arrival, and understand that there was a lot of politics involved in that, no surprise. And that, on some level, the great irony is that this has been, a real headwind and a real, it's almost shot cannabis in the foot. So Nancy Mace comes forward. You got a Republican effort. You got an effort that actually looks to simplify the federal game plan and remove 6 regulatory bodies on the federal level from the mix here, and leave the states to do what they're doing, but give
Yep.
some clearance for getting enough federalization that you unlock some of the biggest headwinds for the industry, which are capital and banking and taxation, and not try to solve social and criminal justice issues, and frankly, not because nobody cares, even on the Republican side, but because
Yep.
it's a more sensible path. So my politics probably did come through there a little bit, and that's okay. And I think, but the price action that was Friday at 3 p.m. with public cannabis stocks hitting fresh lows after an October where the industry was down probably about 9 or 10% across the board on average in the public markets, but after really a period from the highs set on February 11th or 12th, depending on what day, what stock, in the industry off of Georgia runoffs and kind of running through that, where most public companies, the bigger ones, the MSOs, trading down anywhere from 50 to 75% in this country, and the Canadians somewhere from 75 to 85 up north. The whipsaw effect of the macro, so it's a long way of getting to look, probably left a lot of investors worse off than they were when it started, and I think churned up the markets in a way where you may have actually turned off some institutions that were I think sitting on the fence and can invest and maybe were evaluating valuations for a growth industry that really appear like value.
Right.
And I think you knocked a lot of this down. So the federal calendar right now, and I think even the Nancy Mace proposal, while it makes a lot of sense, it's very difficult now, I think, to see anything getting done before midterms. I think there are folks that think actually midterms will be a driving force and a pressure point for Democrats to come forward and bring a cogent plan to the table on cannabis that it's executable and won't have the political football stolen by the Republicans. But I think you're going to have to wait till after midterms, and that actually you'll have on both sides of the aisle have people that know better where they're positioned, and that actually you're going to have probably some change that will not leave some people so all or nothing on this issue. And I think that's where we are. And while we'd all like to see more progress, and the markets would embrace it, there's no question. We've seen the coiled spring, and those November 5th, 3 p.m. to Monday, November 15th at 11 a.m. That was, that period of a week and 2 hours or 4 hours, actually, from the markets, 2.5 hours between Fridays 3 to 4 and Monday mornings 9:30 to 11. You had a 53% trough to peak move in GTI, the biggest company, or one of the biggest, and certainly seen as one of the most kind of blue chip names in the space. So I mean, that's and again, it's not that I worry that we because of that type of price and trading action, you've lost a certain type of an investor. Look, let's face it, you're not getting certain institutions into this space right now, but I just think that that type of a move, and now we've basically reset all the way back down, and this week and late last week there was a couple fresh headlines that gave some inspiration on where there could be some solutions. You have Janet Yellen out there. So you've got the Treasury Secretary. When asked, obviously, think of it in the context of the question line from Ed Perlmutter, that what do you think about taxing the industry? Wouldn't that be good for the government? Of course she's going to say yes. Doesn't mean that she's actively moving to go in there, but sure, would the Treasury like to be taxing the sector and collecting revenue, and would the IRS like to be in control of commerce that's going on? For sure. But the biggest takeaway is, shouldn't we all be happy that cannabis is having this kind of a conversation on a federal level? Right. And did you really think we were going to be here 2 years ago? I don't think we did. So that's a long-winded answer, but it probably required, given how critical this has been, and we have a sector that, as much as I would like to think I'm rolling up my sleeves and looking at companies and doing the stuff that I think, frankly, guys in the private markets can do a little bit easier, we're still reliant on these macro headlines. And so I think that's where we are.
That's really interesting. And so, it's something that I think a lot of us have been aware of as we've been trading the markets. It is very macro headline driven. Does that make it more difficult for a long-term kind of fundamental driven investor to want to get into the asset class? Or do you think that with a lot of these securities being at, close to their 52-week lows, et cetera, it makes it more attractive for them to kind of this be an entry point and kind of hold on and just wait it out and see how things actually turn out over the next few years here?
So there's a lot of recycled money in the public markets here, and has there been some new capital, call it family office capital, maybe some institutional capital? Yes, and I think that there's continuing to be. I think folks are aware that the debt markets have become, I'm not going to say very active, but there's been money raised by traditional secured lending institutions and credit folks in cannabis, different than what we've seen on the equity side. So there really has been some progress for long-term investors. I think you want to be investing thematically, and I think you do also, though. You have to buy the operators that are well positioned, and of course, pushing out the federal landscape is on some level really good for legacy players. I guess from the investment perspective, when we talk sometimes, Tibby, I drop this into the context of a guy that's been investing in emerging markets for 25 years. And when I was in Russia, and I was partners in a Russian bank, and I lived in Moscow for a while, and after the dot-com bust, when you're starting to get this inflection in both kind of commodity super cycle, EM, and we were more excited. So think about what a place like Russia has to offer from a global investor's perspective. It's an EM story, but in many cases, the most investable part of Russia was their oil and gas industry, right? So when we're running around doing some deals and talking to hedge funds, but want the institutional sponsorship that cannabis wants, the most exciting thing was not when Fidelity's emerging market analyst came to Moscow to go visit Gazprom and Lukoil. The most exciting thing is when you started to get their oil and gas analysts. So the sector specific guys, the really sophisticated folks that were looking at Russian oil and gas companies next to Middle Eastern ones, next to U.S. ones, next to BP and Shell. So that's really what the holy grail is for the sector, is when you're getting sophisticated CPG, consumer, food and beverage, some biopharma investors, but sector specific, and I think that's coming. But right now, you have generalists, you have fast money, you have some institutional players that really are tucking this away in a consumer basket and recognize it for what it is. But long term, that is what you're investing in here. Long term, that really is where we all see such a huge opportunity, and this this addressable market dynamic that we all know is bigger than we really should talk about with credibility. And that's fine. So let's be understated here. It's about resetting expectations because the future is really bright.
Yep. No, that makes a lot of sense. And, I think it's somewhere where, and you kind of mentioned this earlier, in the private markets, we're actually able to shield ourselves a bit here. I mean, the industry is growing, 30-40% year over year. I think it grew even faster between COVID and 2020. I think we're expecting about a $25 billion industry this year, and still growing into about a $150 billion black market. So the growth dynamic's certainly there. I think we see a lot of that, especially in the private markets, although we are seeing some valuations start to trade at pretty lofty levels here.
Yeah.
I want to kind of maybe get your opinion on maybe some of the most recent valuations that you've seen out there or heard of in the private markets. And, do you feel like they're justified? Are these valuations that the companies could grow into? Or do you think maybe a more savvy investor would be better off kind of waiting it out?
Well, what's interesting about the private markets here is, on some level, despite, and again, not picking on anyone, congrats to Dutchy, for example, who printed a huge ticket and a valuation benchmark that, the question is that a benchmark? But that, on some level, the private markets tend to have a much more sober perspective on really where the market is, especially when it comes to in many cases, what strategics are willing to pay for each other.
Right.
And so as we've seen in places like Massachusetts and Pennsylvania. So I'm thinking maybe even just getting a little bit outside of tech for a second, but getting into traditional kind of either the vertical model, but certainly the plant touching world, where in some cases you've seen valuations come down a lot, not necessarily because of concerns on federal and this and that. It's really just certain markets are maxed out. People are license capped. There's only so many more players that are going to get into a place and are willing to pay X. The great irony is, I think that on the valuation side of things, there may be more of a focus on a top line, on a revenue line, than there is on an EBITDA line. And that's kind of like, we're kind of coming full circle, because of course, they first started focusing in the industry a few years back, maybe 4 or 5, but it was really about like funded capacity and weird metrics like this that don't really make sense. Although, again, go back to oil and gas and go back to other emerging markets. I mean, people measure a lot of commodity companies based upon what their asset base is, and therefore you can do DCFs on the terminal value of the assets. And so for investors, I get it, but for the folks in the markets that in many cases are making acquisitions and looking at companies and looking at smaller places as bolt-ons, hey, I want to be in this state, or hey, I want to be in this part of the production chain. I need a retail footprint here to complement my, I think they're just not overpaying, and they don't. It's been in a difficult place, but because it's just the reality. And I think that's actually really healthy. I mean, I think there's and therefore you're seeing deals that make more sense based upon strategic fit, not just to go out and buy something in the state of Florida. So that's what's interesting. Look, back to the public market valuations, it's compelling. I mean, we can talk about revenue multiples, or we can talk about EBITDA or adjusted EBITDA. And again, that's part of the problem with talking about EBITDA, because it's not really EBITDA. In some cases it is, but analysts are now going to start talking on the sector, on a 23 multiple, right? And so, very compelling to see, GTI, Curaleaf, Cresco, Trulieve, and Trulieve probably the cheapest of that group. GTI probably the most expensive of that group. Trading anywhere from 8 to 13 times. Then you've got really interesting kind of second tier, and define that any way you want, but or high, low second tier, high second tier, low first tier, but everybody from the Ascends or the Ayers, even like a MaryMed who just had some great numbers, and his company, by the way, I know pretty well because I do some advisory for them, trading at 3 times, or 4 times. And so the market is looking really interesting from a valuation perspective. And so, the deals that have gone on in the tech side of things, I think are a function of really where tech multiples have gone outside of our industry, especially in software, and especially in places where I think there is recognition, and there's the ability to access the cannabis space from tech investors, non-plant touching, et cetera, that allows them to throw a multiple on this that in some senses isn't any more ridiculous than you're seeing with software companies in other sectors outside of this. So great stuff for the sector. We still really need to see GMV growth, and we still really need to see these companies get bigger, because they've promised a lot, and they promised a lot at valuations on the next 12 to 15 months. And in many cases, it is about amalgamating 3 or 4 different parts of the business model, or places where the software, the processing, or the data, or the compliance, sleeve are really coming together. And the holy grail really is that sticky, one-stop shop. And that's part of what I think is going on with the stuff that much better than I do, Tibby.
We're certainly seeing that a lot. And I think that the industry, especially in the private markets, is very ripe for consolidation. A lot of chatter about potential deals going on out there. I think that going into 2022, we're going to hear a lot of completed transactions happening in the market. And, with that, I'll kind of segue into, what some of the Canadian LPs are doing. So I'd love to kind of, first of all, get your take on the difference between the Canadian LPs and the US MSOs, and who you view as more favorable. And then, obviously one of the biggest challenges the Canadians have is the fact that they can't really have plant touching operations in the US. So they've kind of switched their strategy. And we're very close to a lot of these folks to actually going out and looking to acquire a lot of the ancillary businesses. Is that something that you've been aware of or that you're
For
hearing
sure.
about as well?
For sure, yeah, and I wear a banking, a capital markets hat too. I work with Houlihan Lokey, and on some level, a lot of the banks have been able to spend more time, at least focused on the Canadian players. Although, again, the great thing for the industry is I think that really sophisticated and well-heeled, if not top investment banks like Houlihan are now looking at plant touching and more about, or less about bringing deals public than it really is about M&A advisory, structural assessments. And that's where I think the industry, needs a lot of help. And I think that if you look at the Canadian LPs, I think it's easy to be critical, easy to have disdain for the capital markets process that allowed them to have what was Tilray at its peak, a $25 billion company. I mean,
Huge.
it's
unjustified.
It's cartoonish, and a lot of investors were on the wrong side of that trade. And when my CNBC hat, had to be really careful about saying, hey, 3 years ago, folks, I'm very involved in the cannabis industry, really exciting place, but without necessarily shooting down Tilray, but saying this doesn't make any sense, wouldn't make any sense, can't make any sense.
Yeah.
And this is capital markets dynamics. So that's the worst part of the story. And look, and in many cases, companies that I think promised and weren't as transparent with really what the opportunities were in Europe, what the opportunities were with CBD, weren't really as transparent on valuations and what they were spending their stock on. And I think like a lot of early stage industries, what happened in Canada just was more visible. Some of this went on in the US too. But obviously it was playing out on the New York Stock Exchange and on the NASDAQ. And so back to, though, what are they doing and what's the strategy? I don't think that Tilray today, which is really to me Afria but also Tilray and I think but the dynamic that really is you've got arguably the best producer, the most profitable producer in Canada, combined with what they already had, at least in Europe, but married with some of the Tilray access into GMP and whatnot in Germany, coming out of Portugal, but then a distribution business. And I think you've got, look, I'll just talk about Tilray. It's a decent position in my portfolio, and it is so, and only became so after the Afria merger with Tilray, because that to me was a combination of bringing some balance sheet and profitability to some optionality in some of these other markets. I think Irwin Simon knows how to navigate the world of CPG, and I have some sense that they actually are making acquisitions in the US that aren't, hey, we're going to kind of fake you out and buy a beer company and let you think this is going to tell you we're going to backdoor our way into the THC segment in the US. It's like we're actually buying a good brand that's accretive to the balance sheet and is profitable now. And they did that with Breckenridge overnight, as we speak today, December 8th. So I actually give them credit for that. I don't think they're supposed to be punished for that. And if you listen to a Canadian LP CEO, they're going to tell you, hey, it's a little frustrating. As much as the convertible share opportunity and owning the US footprint is great, I use really important and valuable cash on my balance sheet right now. I have no control over this company. And there's still even just some questions about, the convertible dynamics and the ifs, not whens, even though I don't think that's really what it is. I do think having exposure and getting the ability to be there and have the optionality and the convertibility on US federalization is important. And I think those that have made those deals, I think they're, they've been restruck. I think those deals are going to be okay. So look, I think Canada's going to consolidate a lot more. I think Europe is closer than people are giving it credit for.
Interesting.
It's worth focusing on. Obviously, there's been a change in the politics in the most important markets in Europe, obviously Germany, so that you have a more constructive cannabis outlook. And I do think that will be very beneficial to those folks. It's not a game changer overnight, but I think investors have to be really careful about this next 6 to 9 months in Canada. There's going to be some forced marriages. There's some folks that are restructured and are at the end of that rope. We all know that while the Canadian market's actually grown a bit and the addressable market there has improved, and that there's been some greater follow through on 2.0, 3.0, and the government's getting through some of their biggest bottlenecks. It's come on. I mean, it's not really where you want to be investing. So you want to be investing, I think, where you're finding companies that are great companies that are exposed to that market, but that have a profitable, sustainable business that can operate in other places and maybe in other segments, which is what we're seeing.
Well, I knew that this would be a fantastic interview. Really appreciate your time right now, Tim, and all the insight. And I'd say in the spirit of fast money, I'd love to get kind of your top 1 or 2 picks for securities, maybe your top MSOs here in the U.S. What are your favorites?
Yeah. So look, the biggest positions in my portfolio include GTI, Curaleaf, and been adding a little bit to TrueLeaf lately. So I'll quickly just say that I do think the access to capital, the free cash flow generation at GTI and TrueLeaf, especially, which isn't to say it doesn't exist at Curaleaf, are really impressive, and leave these companies in a position where, again, I think they can be tactically bolting on. I think the Harvest acquisition, not simple, but will have proven to be very, very accretive to TrueLeaf. And at this point, TrueLeaf on a top line is basically pro forma, and soon to not be fully consolidated in is the same size as Curaleaf on the top line. And look, Curaleaf has markets where they're stronger in. I think some of the Northeast exposure, and obviously places like New Jersey, that's been frustrating for other operators as well because it's just been moving more slowly. Is still extremely well positioned in some very important states. New York is going to continue to probably move slowly, but it's going to be well worth the wait. And so I guess those are places I feel very comfortable. I feel very comfortable that investors can be involved in those stories. The one story that goes back to what we were talking about that in the tech space, I'll mention Weed Maps, because it's been a heavy weighting in my portfolio now for a year, and I need to acknowledge, first of all, it's been a really tough position to hold for the last 6 months, especially after their last round of earnings. But I look at this as not a company where I have to necessarily guess what they're going to do or be. I mean, right now there's a part of their business that you can guess and where are they going to be in terms of their software and business in a box and things they talk about. And but I'm just more surprised to see that this is a company that their marketplace business, which is very very important to a lot of the MSOs that we've talked about, and is of a scale that others would dream about, is not given more credit in the market. So I'm actually at these levels, I'm more excited. I think it's a company that trades 3 times next year's revenue, and that's really just talking about their marketplace business. And it's a very, very margin friendly business, even if you think yes, it's going to get more competitive and whatnot. But so there's an example of where I just I'm talking my book, I'm being transparent. I've owned the company, and at times it really my ETFs outperformed for the last couple of years other ETFs in the asset class, but and Weed Maps has been painful in the last 3 months, and has cost me I think on the scoreboard. But I met with management recently. I continue to kind of challenge the question. I think I still think it's a really attractive place to be in, and they don't necessarily have to execute on this other part of their business. So look, the MSOs I think that I mentioned are very comfortable and safe. I mentioned there's some some folks like TerraSend, and full disclosure, I have nothing to do with the company, but I work with Jason Wild on the asset management side. So I don't, I'm not over the wall there, but I think, again, incredible positioning. And then I think, look, there is some deep value in the second tier. And I mentioned MaryMed, who I think is a turnaround story that's, going to have a $200 million top line next year and be trading significantly at a discount. There is opportunity out there for investors to, do your work, see if you can best understand the capital structure, because again, a lot of these companies have, at particular levels, either have warrants coming online. In some cases, that's actually not a bad thing for these companies, as they're getting a slug of cash with them. But there's also a lot of unlocks, and because of some of the deals that have gone on, some of these companies are still trying to work through that supply. You can do some of that work. I mean, you can look at the filings, and I think you're going to get a better idea who's going to trade a little heavier during some of these down periods. But I think what we've seen is that this industry is spring loaded. All the companies mentioned are sustainable, yep, and I think are going to be here tomorrow.
Great. Well, I'll have to look at maybe doubling down on my weed maps position after that there. So appreciate the insight. Tim, yep, always a pleasure to chat with you. Thanks so much for joining us on the podcast today. Would love to do it again, and happy holidays, and I'll be in touch.
Thanks. You too.
Take care. Great.